This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
Hello everyone, and welcome back to another video. It's been a little while for me. I've been too busy with kids and buying new fancy microphones. So I got a new microphone, and apparently it's taken me 4 weeks to set it up. So anyways, today we're going to be talking about one of my favorite topics, which is momentum, specifically the momentum factor ETF. I reviewed this ETF a couple times in my video reviewing all the different dividend ETFs, which I know momentum is not one of those. Took a lot of heat for that in the comments section, but I did post another one that goes into the specific reasons why momentum works, including all of the research behind it. So I will link that right here. But today we're going to talk specifically about the most recent momentum rebalance in May of 2021. Got a question from one of the subscribers. He says, "Keep up the great work. Would love you to cover the recent MTUM rebalance and the criticism of people like Joshua Brown who say that momentum ETFs are like driving a car while looking out the rear view mirror." So we'll tackle the second point first from Josh Brown. I don't know exactly what the subscriber was referencing, but I did find this quote from him in a podcast that he did in January 2021. So you can read this whole quote if you would like. But basically he's responding to someone that bought a bunch of NASDAQ ETFs back in January. I think they bought some Tesla, a bunch of things that were up 400 or 500% over the prior 12 months. So Josh says that basically, what's worked over one 12-month period just in general is not always the best performing thing in the next 12-month period. So we'll talk about that in a second, as I do disagree. Actually, the data disagrees with Josh on that one. But then he also says something that I do agree with, which is right here. We have to focus on what's in front of us. So that I definitely agree with Josh on that particular point. Investing is always about what is ahead. It's never about what is behind. So just because a stock or company has done very well in the past does not necessarily mean or guarantee that it will continue to do well in the future. So I agree with him on that. When you're making an investment decision, the best thing you can do is, analyze what do you think the future of this company looks like, and is the current price below what that future cash flow discounted back to today would imply. And if the answer is yes, then it's a good investment. But really that has nothing to do with whether it's up today or down today. All of that should be irrelevant when making investment decisions. However, the reason why momentum has done so well in the past is because of some psychological issues that we as investors have. So we tend to want to keep our losers because we want to, if we paid $100 per share, we want to wait until that gets back to $100 before we sell it. We do not want to sell at a loss. That is irrational and causes us to hold on to losers, making them artificially perform better than they would have if we were rational. At the same time, the big winners in our portfolio, like Apple or Microsoft or Amazon, we tend to want to sell those and take profits off the table. And that's actually irrational. So those companies, in a lot of cases, are going to be the ones that go on to double, triple, quadruple in the future. And if we're constantly taking profits and reinvesting in the loser companies, we're more likely just investing in companies that are dying long term, basically. Not always, sometimes there are values there, but by and large, great companies grow their fundamentals year after year after year. And that means their stock prices are generally going to grow with them year after year, which is why momentum tends to work. So this is some research that actually refutes what Josh said. So let's go back to what he said here. He said, what's just worked over one 12-month period is not always the best performing thing in the next 12-month period. So I'm not exactly sure what he's meaning here, but if he's saying that it's not always the best, then he's right. Just because it worked 12 months ago doesn't mean it will work today. That does not always work. Nothing always works in investing. However, the data suggests that what worked over the last 12-month period generally actually does outperform in the next 12-month period more often than not. So this is research coming from Quantitative Momentum, which is a great book that I would highly suggest that you read if you like technical research-based pieces. But it shows the value of a $100 investment made in 1927 going to 2015. He's using data from Ken French's website, and he is using a 12 to 2 month look back period. So it's basically skipping the most recent month and looking at month 2 back through 12 months ago. So that basically 11-month period, the companies that did really well in the last 2 minus 12 months, how did those do in the future? And he compared those to how did the companies that did the worst over that 11-month period, how did they do? So the winners, the intermediate term winners, are here in this light gray line, and you can see that those did the best. A $100 investment grew to $100 million investing in the intermediate term winners. The intermediate term losers, on the other hand, were these dark black line. They actually lost money over this entire period. And then here you've got the S&P 500 represented by this dotted line that grew $100 to whatever that would be, around, call it 800,000. And then this, really spaced out line is the risk-free investment. So clearly, this would suggest that the intermediate term winners do outperform both the S&P 500 as well as substantially outperforming the intermediate term losers. So the data suggests that actually, while you are technically looking in the rear view mirror, making investments on what has happened, and you can't go back and get those results, it does suggest that by looking at those results, that gives you a clue for what future results will be. So again, I don't want to put words in Josh's mouth. I don't know exactly the context of how he was talking about this. He may have been specifically referencing those that were up 400 or 500%. Maybe those are a bit in bubble territory and momentum wouldn't hold then. But by and large, buying what has been winning will generally do better than what has been losing. That seems to be a fact rooted in a large amount of research that, again, if you want to get more of my thoughts and reviews on past research, you can check out that video. I'll link it again here. Now let's take a look at the most recent momentum rebalance that was done in May of 2020. This is from Wells Fargo. Data sources are here. But basically, this was the MTUM ETF over the last 6 months. It was very heavy in tech. We got a lot of comments, people saying, why would you buy MTUM? Why wouldn't you just buy QQQ? QQQs perform better. Why wouldn't you just do that? Well, the reason is because momentum shifts from what has been working to what is now working, right? So tech was heavy, 40% of the portfolio last 6 months, because that's what had been working before. What's been working in the last 6 to 12 months is not tech. So tech has been underperforming as interest rates have started to rise a little bit. What has done very well, and what does well generally when rates go up, are financials. So you can see that the old weighting in MTUM was 1.6 in financials, basically nothing. Now it is 33.4% in financials. So an increase in weighting of 31.7% to financials. Technology has not been doing as well, so it decreased the weighting by 23.1%. We also reduced weighting in consumer discretionary and healthcare. Both of those by about 8% each. Neither one of those sectors has done particularly great. We did get a modest increase in both materials and energy, which have done quite well. And then a pretty decent increase in industrials as well. So for better or worse, momentum is dramatically shifting to much more value-focused sectors. I don't love that way we talk about value and growth differently. I think they're two sides of the same coin, really. But traditionally, value sectors, MTUM has now overweighted quite substantially there and reduced its weighting in tech. So this is no longer a tech fund or growth fund. This is really kind of a semi-value fund at this point. Still a decent amount of tech exposure, but this is actually below the S&P 500 weighting now in tech. So big bet on financials. The historical momentum data would suggest that that's a good bet to make, but we'll find out. I mean, any 6-month period could be different than history. We just don't know what the future holds. No one does, but research suggests investing based on past momentum has led to good results. If you have any other questions that you'd like to ask, please put those in the comments section. If you want to subscribe, really appreciate that. I also have a new e-course that's available. I'll put a link in the description below. I'm starting a beta course for just beginning investors, and I get a good foundation for what a stock is, what the stock market is, things like that. You can check that out in the description below. You can also sign up for my newsletter. It's free, dividendgrowthmachine.com. Appreciate all of you taking the time to watch, and I hope you have a great rest of your day.